Think back to March 2020. The news channels were running a red ticker all day. Your WhatsApp family group was flooded with screenshots of crashing markets. You opened your mutual fund app and your stomach dropped. Maybe you hit redeem, maybe you called your advisor in a panic, maybe you just stared at the screen and could not think clearly about what to do next. Here's what I want you to hold on to as you watch this video. That frozen foggy feeling was not weakness. That was not character flaw. That was not poor financial discipline. That was cortisol, your body's stress hormone doing exactly what it was designed to do. The problem is, it was designed for a jungle, not for a market downturn. And that gap between the environment your body was built for and the environment your money lives in is the subject of this entire series. This episode is where we get to the chemistry underneath it all. Most investors, if you ask them on a calm Tuesday, will tell you, I am a long-term investor, I won't panic. They believe this very genuinely. But that confidence is built when cortisol is absent. The moment a real market shock arrives, the hormone doesn't ask for your permission, it just acts. This is what most people miss. The problem isn't your intention. The problem is your biology. Research shows that under high cortisol levels, people consistently prefer smaller, immediate rewards over larger future ones. They can't hold the long-term picture in their mind, not because they are not smart, but because the chemical environment in the body physically prevents it. That's the age mismatch at the heart of everything we cover in this module. Your body was optimized for short-term survival. Investing requires long-term patience. And when the two collide, biology wins. Let me give you an analogy that makes this concrete. Imagine a village doctor. On a normal day, he carefully reads test reports, checks long-term trends, and prescribes medicines that takes weeks to work. He thinks in months and years. Now, a patient runs in, bleeding from an accident. Suddenly, the same doctor is not thinking about months anymore. He is only thinking about the next 5 minutes. Stop the bleeding right now. That's the right response in that moment. But what if the patient wasn't actually bleeding? What if the emergency was just a bad blood report, something that needed a calm, considered response, not emergency surgery? That's exactly what happens when your mutual fund NAV drops 20%. Your brain doesn't check whether this is a real emergency. It sounds the alarm anyway. Cortisol floods your system, and suddenly you, a long-term investor with a 15-year horizon, start making 5-minute decisions. The jungle is gone, but your brain hasn't updated the software. So what is cortisol actually doing inside your brain in that moment? Cortisol is released by your adrenaline glands when your brain perceives a threat. In the short term, it's genuinely useful. It sharpens your immediate reactions, boosts your energy, and helps you respond fast. But here's the catch. Cortisol does this by partially shutting down the prefrontal cortex. That's the part of your brain responsible for long-term planning, rational thinking, and patience. We covered the tug-of-war between the amygdala, your brain's alarm system, and the prefrontal cortex, your planning brain, in earlier episodes of this module. The short version, when cortisol spikes, the amygdala wins every time. And the market knows exactly how to trigger that spike. Red numbers on a screen, a panic headline at 9 a.m., a WhatsApp message from a relative who says, I told you so. Each of this is a small cortisol injection. Enough of them and your planning brain goes offline. Here is something important that most people don't realize about this. It is not the loss that triggers cortisol. It's seeing the number. Think about real estate. Unlike equity, property doesn't show you a daily mark-to-market figure. There is no app that tells you your house is worth 12% less than last month. And because of that, most investors feel calmer holding property even during the same macro environment that's crashing their equity portfolio. The asset class hasn't changed, only the visibility of the price has. This is not a design flaw in equity, it's information. But it's information that arrives faster than your prefrontal cortex can process it and lands directly in the amygdala's inbox. Two drivers, one car, and one cortisol puts the amygdala behind the wheel. There is only one destination, that is panic. Let's look at what this actually costs in rupees across different asset classes. Equity mutual funds first. The Sensex fell roughly 38% between January and March 2020. But by December 2020, it hadn't just recovered, it had crossed its pre COVID high. An investor who redeemed in March at 25,000 Sensex levels and re entered in December at 47,000 levels didn't just miss the recovery, they crystallized a loss and then bought back at the nearly double the price. Now, gold. Gold is often bought as a safe haven during panic. But many investors who rushed into gold ETFs in mid 2020 at peak prices of 55,000 rupees per 10 grams held a flat or negative real returns for the next couple of years. Panic buying is just as dangerous as panic selling. It just feels different. And debt funds. During the fragile Templeton crisis of April 2020, investors reacted with fear and redeemed from other debt funds too, funds that were perfectly healthy. The cortisol response doesn't distinguish between a real threat and a nearby threat. Everything felt dangerous. The market didn't take that money. Cortisol handed it over willingly in exchange for the feeling of safety. And this isn't once in a generation event. Every market cycle produces the same pattern. Fear spikes, cortisol fires, investor sells at the bottom. Markets recover, investor re-enter near the top. 2008, 2030, 2020, 2022. Different triggers, different headlines, different asset classes. Same biological response and same financial cost. The mechanism doesn't change because the market doesn't change what it is. A daily high visibility, emotionally loaded number that your amygdala checks before your spreadsheet does. So what do you actually do with this? The goal isn't to eliminate cortisol. You can't and you shouldn't want to. It protects you in real emergencies. The goal is to build structures around yourself so that cortisol can't reach your financial decisions. Here's what that looks like in practice. Rule 1. Write your investment policy before the crisis, not during it. When cortisol is low and your prefrontal cortex is fully active, document exactly what you will and won't do during a market fall. Specific rules written down. If the Sensex falls more than 20%, I will not redeem, I will increase my SIP. That sentence, written on a calm day, is worth any amount of willpower in the middle of a crash. Rule number 2. Set up a SIP and step away. A systematic investment plan removes the decision entirely. The investment happens automatically, regardless of what the market is doing or what cortisol is doing to your brain. No trigger, no panic. Rule number 3. Reduce how often you check. If you check your portfolio every day, you will see a loss on roughly 47% of those days because markets go down almost half the time on any given day. Each of those red days is a small cortisol shot. Reduce check-ins to monthly or quarterly and your emotional baseline changes completely. Rule number 4. Keep a cash buffer. A liquid fund or short duration debt holding 3 to 6 months expenses does something powerful that removes the feeling of financial emergency during market fall. If your daily needs are covered, your brain doesn't register the portfolio drop as a survival threat. The cortisol spike never fully fires. And rule number 5. This one takes 30 seconds and it genuinely works. Before you redeem or panic buy, write one sentence. I want to sell because I feel afraid that. The act of naming the emotion engages your prefrontal cortex. Researchers call this effect labeling. It is a psychological circuit breaker. The amygdala loses some of its grip the moment you put words to what it's doing. Cortisol doesn't work alone. When it's high, loss aversion becomes extreme. Herding becomes irresistible. Pattern recognition goes into overdrive. And the narrative bias, whatever scary the story is trending that day, latches on hard. One hormone under the right conditions can activate every bug in your mental software at once. That's how bear market destroy not just portfolio but financial confidence for years afterwards. But chemistry can be anticipated. It can be planned around. And with the right structures in place, you can make sure the next market shock doesn't reach your decision-making brain before your return rules do. Your portfolio isn't just a collection of assets. It is a test of your nervous system. And given that we are all wired this way, the real question this series is built to answer is, how do we invest intelligently anyways? That's what every episode from here is about. See you in the next one.